The purpose of this video is to give you some information about annuities that your annuity salesman may not have already given you. I'd like to start by pointing out that an annuity is an insurance contract, not an investment. An annuity contract will have two phases, a savings phase and an annuity phase. During the savings phase, you can contribute money to your annuity contract. The annuity contract provides you with a guaranteed rate of return regardless of stock market performance. Consider this: if you are having a hard time being patient during market lulls or drops, remember what's potentially at stake in the handoff between bear and bull markets. From 1942 to present, over 80 years, the average bear market lasted 11.1 months, with an average magnitude of negative 31.7%. Over the same time period, however, the average bull market lasted 4.4 years, with an average magnitude of 155.7%. Bull markets are longer and stronger than bear markets. The growth market is why we are invested longer and stronger. From 1926 to 2014, over 50% of the positive growth years have been plus 20% of growth. So let's say that the contributions you put in, the length of time you served, and the guarantees you were provided you with a contract value of $240,000 when you're ready to annuitize. At the beginning of the annuity phase, you trade your original contributed money and your contract value for an annuity. The annuity is generally a guaranteed lifetime income, but your original investment and the contract value are gone for good. There are essentially two kinds of annuities: a deferred savings annuity, which has both a savings phase and an annuity phase, and an immediate annuity, which skips the savings phase and goes straight to the annuity phase. So with an immediate annuity, you simply trade your $240,000 for their promise to pay. But regardless, if it is a deferred savings annuity or an immediate annuity, if you have an unexpected financial emergency, your $240,000 is gone, and you can only look to your mailbox for the annuity payment, which in this case is $1,000 a month. The financial security that annuities provide can make them a very strong appeal, but to really understand what you're getting, you have to map out the cash flows in the annuity phase. To do this, we'll set up a timeline. The annuity example used here is a real-world scenario where a husband and wife, age 65 and 67, were about to retire and were considering an annuity. The annuity would cost them $240,000, and it would be an immediate annuity. For that, they would get $1,000 a month. At the end of 20 years, they will have received their $240 $1,000 payments for a total of $240,000. In 30 years, they will have received $360,000. In 40, $480,000. And if they were lucky enough to live until the age of 115, they will have received $600,000 from their annuity. In this case, as is the case in most annuities, it takes about 20 years to get your original investment back. The life expectancy of the younger spouse is 85, exactly 20 years from inception of the annuity. So you don't have to buy an annuity because you're concerned about living to your life expectancy. For that, you can put your money in a piggy bank and take it out in even amounts over the remaining 20 years. You buy an annuity because you're concerned about substantially outliving your life expectancy. It's called longevity insurance. But an annuity plays tricks on your mind, like a shell game. While you've got your eye on the $1,000 per month payment for the rest of your life, your mind forgets to think about purchasing power. So let's take a closer look at purchasing power. Consider this two-story, three-bedroom home in 1934 could be purchased for $1,092. In 1990, you could purchase a two-story, three-bedroom, two-bathroom home in Spokane for $28,000. What you've done when you've purchased an annuity is you've sheltered yourself against market risk in exchange for the certainty of loss of purchasing power. To really understand it, you have to map out the cash flows. In 20 years, when you go to the grocery store with your $1,000 payment, due to 3% per year inflation, it will only buy $548 worth of goods. In 30 years, $406 worth of goods. In 40 years, $301, and in 50 years, $223. You also have to consider the effect of core versus headline inflation. Core inflation is the long-run trend in price levels in the United States. As you can see on this graph, core inflation has been around 3% since about 1990. From 1968 through 1990, core inflation ran significantly higher in the United States. While most people have heard of core inflation, most people have not heard of headline inflation. Headline inflation is your personal household inflation rate, a measurement of price inflation that takes into account all types of inflation that an economy can experience. Headline inflation is more useful for the typical household because it reflects changes in the cost of living, while core inflation is used by central banks because core inflation is less volatile and shows the effects of supply and demand on GDP better. What if you purchased everything you purchased last year all over again this year? What percentage increase would you expect it to be? 3%, 4.5%, 6%? The answer would be your headline inflation rate rather than the core inflation rate. Consider that minimum wage in Washington state increased by 16% at the beginning of 2017, impacting many consumer products. Since then, the minimum wage has increased by an average of 7% per year. So again, let's map out the cash flows at 4.5% inflation. In 20 years, when you go to the grocery store with your $1,000, it will cost $406 worth of goods in today's money. In 30 years, $259. In 40 years, $165. And in 50 years, your $1,000 buys what $106 buys today. At 6% headline inflation, in 20 years, your $1,000 buys $301 worth of groceries in today's money. In 30 years, $166. In 40 years, $90. And in 50 years, $49. The annuity contract is a shell game that takes your eye off the loss of purchasing power, which is a primary risk to wealth. So let's look at the alternative, keeping your money invested in well-diversified equities. Our three pillars of investing: achieving market returns, low risk and low fees, and taking a wealth-centric approach to guide us. Once again, let's start with our timeline and map out the cash flows. The very worst 40-year annual return on the S&P 500 is 8%. We invest our $240,000 at the very conservative expectation of 8%. The first 5% of that return provides $12,000 a year or $1,000 a month. The remaining 3% can be used for growth. At the end of 1 year, the 5% generates our $12,000 that we live on, and the 3% generates $7,200, which can be added to the $240,000. At the end of 1 year, we have $247,200. In 20 years, we've received our $240,000 in monthly payments, and we have a remaining $438,073 in our portfolio. In 30 years, we've gotten the same $360,000 as we would have gotten from the annuity. But unlike the annuity, we have $590,658,000 remaining. In 40 years, we've gotten our $480,000, and we have $797,625 remaining. In 50 years, we've gotten our $600,000, and we have $1,075,447 remaining. It would be unusual for a retired person to have all of their money in equities. A more likely scenario, a very conservative scenario, is a 50-50 portfolio with half the money in bonds and cash and half the money in equities. A 50-50 asset allocation for which a 5% return expectation is extremely conservative. To illustrate how conservative a 5% return expectation is on a 50-50 portfolio, take a look at this chart from Index Funds Advisors showing a 50-year period ending June 30th, 2024. In a 50% equity and a 50% bond portfolio, the annualized return was 9.2%. Again, returning to our timeline, at just the 5% return expectation, we invest our $240,000. Our 5% produces the $1,000 per month, and 0% was left for growth. In 20 years, we received our $240,000, but we still have our principal intact, $240,000. In 30 years, $360,000, and we still have our original $240,000. In 40 years, $480,000, and in 50 years, $600,000 with our principal intact. Pillar 1, market returns, demands that we stay invested to protect our long-term wealth. Pillar 3, a wealth-centric approach, demands that we keep our eye on the big picture instead of focusing on the shell game that the annuity contract creates, which tends to give us tunnel vision and keeps us so focused on the short-term ups and downs in the market. We need to keep our eye on the big picture. This is the chart of the S&P over time. This is the chart of the purchasing power of dollars invested in the S&P over time. This is the chart of a fixed monthly payment. And this is the chart of the purchasing power of a fixed monthly payment. At the point where you annuitize your contract, you've locked in the long-term decline in your purchasing power. There is just one more thing we need to discuss. You'll remember that regardless if it's a deferred savings annuity or an immediate annuity, once it's annuitized, if you come across an unexpected financial emergency, your $240,000 is gone, and you can only look to your mailbox for the $1,000 a month. But what happens if you're still in the savings phase and you come across an unexpected financial emergency? You'll have to surrender your contract, in which case you give up the contract value, and what you get back are your original contributions less a bunch of fees. Most likely you'll get back a smaller pile of money than what you put in. The fees charged for surrendering a contract include the surrender fee, which typically starts at 10% and declines by 1% per year over 10 years. If your annuity is surrendered in the first year due to a financial emergency, you get back 10% less than you put in. The annual fees charged to the original contributions include internal fund fees from the investments that they're invested in, administration fees, mortality fees, death benefit fee, and other rider fees. The total is typically between 3 to 5% per year. In this signature page, taken from an actual annuity contract, they're telling you exactly what I've just said. I understand that any surrenders during the first 10 contract years could trigger surrender charges and could mean that I will get back less than what I put into the annuity. They're asking you to acknowledge that you understand you cannot annuitize until at least age 60, moving you closer and closer to your life expectancy. And finally, most importantly, they are asking you to acknowledge that you understand an annuity is an insurance contract, not an investment. In spite of everything that I've shown you to this point, people still ask about inflation-protected annuities. There are inflation-protected annuities, but they're not widely promoted. The price on them is worse, meaning that you get a lower annual payment percentage. It's tied to core inflation, not headline inflation. And quite frequently, like index annuities, they have a cap. In this case, it's the percentage of inflation protection you can get at any particular year. Remember, an annuity contract is a shell game. It takes your eye off the big picture and tricks your mind into thinking it's an investment rather than an expense. It slowly robs you of your purchasing power over time. The 3 pillars of investing will always guide us to a secure financial future. Market returns. A fully diversified portfolio is inherently inflation adjusted. Using a long-term annuity product to protect against fear of a short-term market fluctuation is a bad solution. Low risk and low fees. Why put your financial future in the hands of just one company when a fully diversified portfolio invests in them all? Consider that of the top largest companies in the United States in 1900, only 16 were still around in the year 2000. A fully diversified portfolio invests in all the companies, not just one. And finally, use a wealth-centric approach. Purchasing power is a significant risk to your wealth. Keep focused on the big picture. Market returns over the long term will protect the purchasing power of your wealth. With the proper asset allocation and an awareness of your situation, we can manage through the short-term ups and downs of the market with success and lead you to a much stronger financial future. We hope this video has helped you put into perspective that annuities are insurance contracts and not investments. As such, they can be an expense to your wealth and to your long-term purchasing power. There is absolutely no doubt that if you map out the cash flows from an annuity and compare it to a well-diversified portfolio, the disparity will be so broad that you will never consider an annuity as an investment. Stick to the fundamentals, keep it simple, and you'll be just fine.